two past question papers. First, I will start with 2016 May paper. These things are, I think, available at the beginning of the lecture series. I'll read out the question first. You are the credit officer of Allianz Bank PLC. Your bank name is Allianz. Then Alpha Business Solution Limited is one of the leading suppliers of software solution for local and export market, and a prime customer of your bank. It maintains a satisfactory conduct of current account at your bank with an average balance of LKR 10 million. At present, it enjoys the following credit facilities. There are two facilities, namely term loan, sanction limit or the approval limit is 80 million. Outstanding as at a particular date, that is 31st March 2016, 62 million, they are within the limit. Then there is a overdraft facility approved 20 million, but the current limit is they have exceeded that limit, that is 26 million. Alpha Business Solution has plans to expand its business. Recently, the company had signed 3 contracts, 2 of which are from overseas clients, to deliver software solution within the next 6 months. In order to meet this requirement, the company has purchased 6 computers and recruit experienced staff. The company requires additional facility of 10 million to meet the working capital requirement, right? The chief financial officer of Alpha Business Solution had approached your bank for additional facilities to meet their requirement. You as credit officer had requested for the income statement, financial position statement of the company for the financial years 31/3/2014, 15 and 16. The summarized audited results for 2014, 15 and unaudited financial results for 2016 are given below. Starting from income statement, starting from turnover, they have given cost of sales, gross profit, expenses, profit before tax and interest, deduct interest, profit on ordinary activities, deduct taxation, net profit after tax. Then they have also deducted, even though this is not a part of the normal income statement, they have also deducted the dividend income, and they showed retained profit for the year. You have to remember the last column, that is 2016 one, that is unaudited. 20,000 is the retained profit. It should be there in the balance sheet in 2016. Then statement of financial position of the balance sheet. Starting from non-current assets, they have this tangible assets, that is non-current asset, written down value. Then current assets, under current assets, work in progress, receivable, cash and cash balance. Then under total equity and liabilities, capital, and there are some reserves. Non-current assets, there is a loan, that is 62 million, that is the loan that they have taken from our bank. If you go to the beginning of the question, they say the current outstanding of the loan is 62 million. And the current liabilities, they have this trade payables and bank overdraft. Bank overdraft also in 2016 column, you can see 26 million is there. That is current overdraft outstanding amount. Right. If you go to the retained profit, the 2015 figure is 46,000, 16 figure is 66,000. There is a difference of 20,000. That is the retained profit transfer from the income statement in 2016. You have to make a note of all these things. You have to cross-check your balance sheet P&L when a client produce the same for your perusal. There are some additional notes. Work in progress is the cost of work performed, not invoice. That is not it is not that a big deal. Meaning work in progress means the items have not completed yet. Now, if you take the stock item, there are raw materials and work in progress items and the completed finished goods. Right, this particular stocks is not finished. Now they have valued that work in progress at their cost. Therefore, we have to merely take that cost into account when we prepare various ratios. Work in progress is equal to stocks, right? Stocks are the three types: material stocks, work in progress stock, and finished good stock. Under additional information, they say you may assume that the trade receivable, trade payable balances reflected in the balance sheet are average balances, right? You may use year-end figures in the financial position statement for computation of ratios, right? Meaning they have straight away said, the examiner has straight away said you need not to calculate the average balances, you have to take the year-end figures, right? In that case, you need not to take the average balances as far as the balance sheet figures are concerned. You take the year-end figures, right? And the point two, it is straight away they have commented on the average figures. No need to take the average figures. In case of balance sheet figures or statement of financial position figures, you have to take the year-end figures. Then companies has issued 6 million voting ordinary shares. That will be taken into account to calculate various ratios. Then they have given the market prices of 2014, 15, and 16 of this particular company. For you to have a market price, it has to be registered with the Colombo Stock Exchange. In this case, we have to assume that they have registered in the Colombo Stock Exchange. Their shares are trading. And straight away, the examiner asks for you to calculate the ratios given below, starting from gross profit to dividend yield. He has allocated 18 marks, meaning for 12 ratios, one ratio carries 1.5 marks. In this particular part, you have to only calculate the ratio and do some interpretation only. Then based on number two, based on the results of the ratios computed under one, state brief, comment on the financial analysis and explore the risk position, right? Under second question, you have to interpret the ratios calculated and the risk involved with the ratios. Last week I mentioned for individual category of ratios, that is like profitability, liquidity, and efficiency. Capital structure, then investor relation. For individual category, you have to express an opinion about the risk position, and overall risk position also you have to express. That is required under part 2. He has allocated 5 marks for that, right? Number 3, in the event of considering additional facilities, describe the type of facilities you may recommend, right? If the client needs additional facilities, what kind of facilities you can request? We will start the question, right? First, we have to calculate the 12 ratios out of the information given in the question. Now, in the question itself, they said no need to take average balances. You have to take the year-end figures in case of statement of financial position balances, right? You know, when to take average balances, but in this question no need to take the average balances. But if you are calculating a ratio from the items from income statement and another item from a statement of financial position, the items from statement of financial position should be an average balance. But in this case, they said no need to take average balance, take the year-end figures, right? Starting from gross profit ratio, we go to the question, go to the income statement. For you to calculate the gross profit ratio, there should be two figures available. That is gross profit and sales. Gross profit and sales. Now, in the income statement, you have to correctly take the gross profit, not anything else, right? When I am correcting papers of previous batches, students of previous batches, uh, some people incorrectly they have taken instead of gross profit, they may take turnover, they may take cost of sales, right? But all the figures are straight away given in the question itself. Therefore, don't be that much negligence. Uh, it will help you to fail the exam, right? This is a very easy ratio for you to calculate. Won't take at least 1 minute for all 3 years to calculate, right? Therefore, make sure that you are not making any mistakes as far as these very easy ratios are concerned, right? Then straight away you take gross profit and sales. Then the answers for 2014, 15, and 16 will be 34%, 37%, 36%. Right. I think somebody's mic is on. Make sure that it is muted, right? නැත්නම් ගෙදර කතා කරන්නේවත් මෙතන ඔක්කොම ඉස්සරහ හැයි මයික් ඔන් කරන එක්කෙනාගේ නම කියන්න වෙයි නැත්නම් ඊට පස්සේ ඔයගොල්ලෝගේ මයික්ස් ඔක්කොම ඔෆ් කරලා තියාගන්න. Right, thank you. If you take this gross profit ratio, it should not be vary from year to year. Now you can see clearly it is within the particular range, that is almost 35% to 37%. There is a small decline in 2016, but that is not that much material, but it is within the range 35 to 37%, very identical ratios, right? Now we'll take some time under question 2. We have to make some interpretation. We'll do that at a later stage. First, we calculate all the ratios. I think no need to waste any more time on calculating this gross profit ratio. It's very straightforward. You can easily calculate. Right. We'll go to the second ratio that they have requested. They have requested for you to calculate the net profit ratio. Net profit ratio. We'll see how your net profit ratio can be calculated of this company. Now, one mistake I identified. Now, in the income statement, we go to income statement. Income statement. Starting from turnover, the last item is the retained profit for the year, right? When I am correcting paper, some people have mistakenly taken this retained profit for the year instead of net profit. For you to calculate this particular ratio, you need to take the net profit. Net profit divided by sales into 100, right? Don't take the last item. That last item in the income statement is the retained profit, right? There is a specific line item named as net profit after tax. You have to take that, right? Make sure that you are taking this particular item. Don't take the last item in the income statement, right? In this income statement, last item is not the net profit after tax, right? It is the retained profit. Make sure that you are taking the net profit after tax for this net profit ratio calculation, right? There is a one mistake I realize at least 5 people are there in incorrectly doing that mistake, right? Make sure that you are not doing that mistake in the exam, right? If you take the net profit 2014 29,000, 15 55,000, 16 56,000. When sales the same items 450, 670, 890 for 14, 15 and 16. Then very easy to calculate without taking much time. The answers will be 6.44, 8.21 to 6.29, right? We'll have an interpretation at a later stage, but going through the results of this company, 6 points, its net profit ratio, it's ranging from 6.4 to 8.2. But the current year, the latest year, 2016, the net profit ratio have further declined. But for a company to survive at a net profit ratio of 6.6%, it's not that much practical. Therefore, there should be some improvement for the net profit ratio. If you net profit ratio means if a company invested 100 rupee, they have a net profit of 6 rupee. That is not that much attractive for a company, right? Therefore, make sure, not the investment. If you generate 100 rupees sales, you have a 6% net profit, right? In the gross profit ratio, if you have a 100 rupee sale, you have a GP of 37%. Now, from 37% to 6% means further reduction of 30 percentage, otherwise 30%. From GP to NP, their expenses are very much higher. Now, these are other expenses, not the main expenses. All the main expenses are captured under the cost of sales. But for you to have this company to have this much of a reduced net profit ratio, there are some problems in the admin and distribution cost or finance cost in their P&L. That is the latter part of the P&L, right? Therefore, we have to have a good comment on the net profit ratio. This is not that much acceptable for a bank, right? Then next ratio, next one is the return on equity. Return on equity. We'll calculate the return on equity. You know how to calculate net profit after tax divided by equity capital. In this case, net profit after tax is an item from income statement. Equity capital is an item from balance sheet. Then, according to the what I explained last week, the item from the balance sheet should be an average one. But in this question, it is clearly mentioned no need to take average balances in case of balance sheet item. You have to take the year-end balances, right? Therefore, don't waste your time in calculating average balances. But if you calculate the average balances, there is a problem for you to calculate in 2014 figures because 2013 figures have not been given. right? For you to calculate average balances on 2014, 2013 figures should be given. It is not given. Therefore, you have to compare with apples and apples. And the question itself says don't need not to take calculate the average balance. Take the year-end balances in case of balance sheet figures. Right. We'll take the net profit after tax. According to the ratio, we have to take the net profit after tax. 2014, 15, 16 figures are given 29,000, 29,000 and 55,000, 56,000. Right. Meaning 29 million, 55 million, and 56 million. Then equity capital, you have to go to the balance sheet, and the balance sheet equity means the total stated capital and the reserves. Total stated capital and the reserves. Under balance sheet, capital and reserve, stated capital and the retained profit. Then you can straight away take the equity. That is 108,000, 136,000, and 156,000. That is the total of stated capital plus the reserves. Only reserves we have in this company is the retained profit. Retained profit, right? Then you have net profit after tax and the equity capital, right? Then you can calculate the return on equity. Return on equity. The answers will be 26.85, 40.44. Then there is a decline 35.9. 35.9. Now our interpretation will be done after this calculation, all of these ratios. We will do it separately. But if you take 2016, 36% is very acceptable for a company return on equity. But there was some decline compared to 2015. But even the 35%, 36% ratio is very acceptable for a ratio of return on equity. Right, we'll go to the next ratio. According to the question, they want us to calculate the return on capital employed. Return on capital employed, that is also under profitability ratio. GP, net profit, return on equity, then the return on capital employed. Right. Under return on capital employed, I explained the ratio first. You have to take the net profit before tax plus interest, meaning you have to take the net profit before tax and interest, right? Take the net profit before tax and interest, divided it by equity capital and the long-term capital into 100, right? You have to take the total capital, that is total capital comprised of two parts, equity capital, that is actual owner's money, and long-term debt capital, that is what we have borrowed from our banks. Then take the total, that is the total capital. Compare it with the net profit before tax and before interest, right? Before tax and before interest as a percentage. I took the net profit before tax from the income statement, 36,000, 67,000, and 72,000. Then add back the interest. Add back the interest. That is 18,000, 28,000, 42,000. Then you have net profit before tax and interest. Answers are 54, 95, 114. Then equity capital you have already taken for the last ratio computed. That is 108, 136 and 156. Then for long-term capital, you have one item, that is a loan taken from your bank according to this particular question. That is from what bank? Alliance Bank. Figures are 30 million, 78 million and 62 million. Then the total capital employed is take the total of equity capital and long-term debt capital, 138, 214, 218. Then calculate the net profit before tax and interest as a percentage of the total capital. Then it will be 39%, 44% and 52%. These ratios are very attractive, and you can see a growth in the ratio itself from 39% to 52%. Even a 39% ratio is very attractive. This means every 100 rupee, the total capital you employed, you have a return of 52 rupee. You have a return of 52 rupee. That is 50% return. 50% is return. Very attractive. Two 2014, 15 and 16. But make sure in this case also we have not taken average figures, right? But normally you have to take the average figures for the balance sheet item, that is equity capital and long-term debt capital. But in this question also, it is very clearly mentioned, no need to take average balances, take the year-end balances. That's why we took the year-end balances. But when you are doing the next question, you can see we'll take the average balances for these ratios, right? If a ratio is computed, one item from the income statement and another item from the balance sheet item should be an average figure, right? Balance sheet item should be an average figure. Right. We'll go to the next ratio. Under profitability, they have required only 4 ratios. Then for liquidity, they have required current ratio. Now, even though it is not required, I have calculated the interest cover ratio also. In the question, it is not required, but I have calculated the interest cover ratio also. Interest cover ratio is calculated. You have to take the net profit before tax plus add the interest, then divide the total by the interest itself. Then if you go to the question, net profit before tax 36,000, same figures we are using. If you commit a mistake in a one figure, since we are using the same figure again and again for calculating different ratios, the losing of marks will get repeated, right? But I will make sure that if the calculation is correct, even with the wrong figures, you will be allocated with some marks, right? Don't worry, but make sure that you take the correct figures for your calculations, right? For this ratio, interest cover, net profit before tax, add the interest, then you have net profit before tax plus interest, then divided it by interest again. Then you have a ratio of interest cover 3 times in 2014, 3.3 times in 2015, 2.71 times in 2016. If you can remember, this ratio means the number of times using your profit, how many number of times you can pay interest. The higher the number of times, better it is. In 2014, you could have paid 3 times using your profits, the interest portion 3 times. 15 they have improved, that is 3.4 times. That is an improvement. But in case of 2016, the ratio have come down from 3.4 to 2.7. That is not a good sign, but not that much. The ratio has not that much come down, but there is a reduction. The higher the number of times, better it is. Higher the number of times, better it is. Right. Then we'll come to the liquidity ratios. Under liquidity, it's very easy to calculate these ratios. You have to directly take the balance sheet figures. That is, under current ratio, you have to take the current assets and the current liabilities. Go to the balance sheet, take the current assets and current liabilities. 2015, 14, 15, and 16. Divided the current assets by current liabilities, meaning for one single current liability, what is the current asset your company has. Now, in case of 2014, for one current liability, the company has 1.78 current assets. For 2015, it has improved. For one current liability, the company has 2.06 current assets. For 2016, one current liability, the company has again almost two current assets. Normal standard is for one current liability, there should be two current assets at least. That is normal standard, but the ratio will get differ when it's come to different industries, right? For insurance, for tourism, for education, for normal trading and manufacturing. But normal standard norm is for one current liability, you should have two current assets. That is current ratio standard. But in a bank, you can develop taking into account the average figures of all the companies belong to a particular industry. Say you in the tourism industry, you have like 20 companies, that you have exposures for 20 companies. Take the current ratio of all these companies and compute the average figure. Then that might be an industry figure for you to do a particular comparison as far as a single company is concerned. Similarly, for other ratios, you can compute the same way. But the normal standard for the current ratio is 1:2. For every current liability, there should be two current assets. Then second ratio under current assets. Therefore, this company's current ratio is very acceptable. It's within the range. We can have a comment on the latter stage. Then go to the second ratio under liquidity, that is quick asset ratio or asset test ratio. In that ratio, we have to take off the stocks from the calculation of current assets. For the stocks, we have only the work in progress stocks. I mentioned earlier also, work in progress stock is also a stock. Stocks can be of three types, that is raw material, work in progress, and the finished goods, right? All three are stocks. Make sure that all three are valued at cost, right? We take off from the current assets in order to take the quick assets, the inventories. Therefore, quick assets for 2014, 21 million. For 15, 32 million. For 16, 44 million. Then current liabilities will be the same, 23 million, 32 million, and 44 million. Then the ratio will be 1 is to 0.91, 14, 1 is to 1 in 2015, 1 is to 1 in 2016. Normal acceptable ratio is also 1 is to 1. That is normal acceptable ratio. But as I mentioned earlier, for different industry, this ratio can be, yeah, not only the quick asset ratio, current ratio, you have to have your industry averages, right? But in case of this company, 1 is to 1 is very acceptable. You have a good liquidity position. Both current ratio and the quick asset ratio are within the range. We'll explain, or we will do a writing on in a later stage for the interpretation part. Then that's it for the liquidity ratio. Then we can move on to the gearing ratio. Last week I explained you there are two types of gearing ratios. That is gearing ratio 1. In the gearing ratio 1, you take the equity capital and the long-term debt capital. Equity capital and the long-term debt capital. You calculate compared to equity capital, what is your debt capital. If it is below 0.5, then you say low geared company. If it is higher than 0.5, you say if the answer is higher than 0.5, you say it's a high geared company, right? Therefore, you have to take for you to calculate the gearing ratio 1. Now, these gearing ratios, as mentioned in the last week, gearing ratios are the ratios most of the people find it difficult to calculate. There is no difficulty in calculating this ratio if you understand understand correctly the thinking. You have in the first ratio, you have to take the long-term debt capital and the equity capital. You divided the long-term debt capital by equity capital. If you go to the second ratio, for debt capital, you have to take not only the long-term debt capital, you have to take the short-term debt capital like overdraft and take the total debt capital, right? Total debt capital. Add the equity capital, then you can have the total capital. Total capital. Then you take a fraction or the figure divided by total debt capital divided by total capital. If it is below 0.5, you say it's a low geared company. If it is higher than 0.5, you say it's a high geared company. In case of first ratio, I mistakenly stated that it should be 0.5. It should not be the 0.5. It should be 1. If it is more than 1, you said high geared. If it is less than 1, you said low geared company. Right. Now, coming back to the question again, if you calculate the gearing ratio 1, that is long-term debt capital divided by equity capital, take the long-term debt capital from the balance sheet, that is 30 million, 78 million, and 62 million. Under non-current liabilities, the only one item is the loan given by, term loan given by your bank to this particular client, right? 30 million, 78 million, 62 million. Then take the equity capital. We have taken the equity capital for several ratios. Therefore, no need to explain it again. Equity capital straight away from the balance sheet, 108 million, 136 million, 156 million. Then divide the total debt capital divided by equity capital. Then the answers will be 0.28, 0.57, 0.4. All are below 1. Therefore, this company is a very low geared company. Low geared company, very attractive for further lending. If it is a low geared company, very attractive for further lending because they have not heavily used the debt capital in asset financing. Therefore, you have a very good chance of lending for these people, right? If it is a low geared company, make sure that you are lend to those people because they have not relied that much on debt capital. The bulk of the capital have been coming from the as a equity. Equity holders contributed more if it is a low geared company, right? For asset financing of that company. If you go to the second ratio, that is gearing ratio 2, right? I already explained for gearing ratio 2, you have to take for debt capital, you have to take the not only the long term capital, you have to take the short term debt capital as well. Then you calculate the total debt capital at the equity capital. Then you can have the total capital. Total capital. Calculate the total capital first, then compare total capital with the total debt capital. Right? Divide the total debt capital by total capital. If the answer is below 0.5, you say low geared. If it is higher than the 0.5, answer is higher than the 0.5, you say high geared company. Right? We'll calculate the gearing ratio to long term debt capital. That is 30 million, 78 million, 62 million, what we have used in the previous calculation. Then for short term debt capital, you have 3 items, that is only the overdraft part. Don't take the trade payable part. Overdraft part you have to take. That is kind of a debt, permanent debt. Then adding the short-term debt, you can arrive at a figure of total capital, that is 41, 96 and 88 million for 2014, 15 and 16. Then add the total capital, total equity capital plus the total debt capital. Then you have a total capital of 149, 232, 244. Then divide the total debt capital. If you take 2014, I am going to divide 41 million by 149 million. Then the answer will be 0.28. Similarly, for 2015, 96 divided by 232. The answer will be 4.1. Then 2016, 88 million divided by 244. Then the answer is 0.36. All answers are less than 0.5. Therefore, again, in under the second ratio, this company is a low geared company. Low geared company. They out of the now, if I further explain the answers in 2016, it says 0.36. 0.36, meaning out of the total capital, debt capital only 0.36, meaning 36%. The balance 64% are from the equity. Balance 64% are from the equity. Therefore, there is a good chance of you to lend, your bank to lend this particular client. Right. Then that is for the capital structure, gearing ratio 1 and gearing ratio 2. Then they need these investor relation ratios, starting from earning per share, right? Very easy to calculate. All of these ratios very easy to calculate, but make sure that you have to take the correct figures, right? If you can do this question at the first instance, right, at the very first starting from very first minute of your exam, then you can easily get the 28 marks or 30 marks allocated for these questions. Don't do this question in a hurry, right? Now in those situations, it will now you tend to make more mistakes if you are doing this question. Now most of the people, they try to do the other question and keep this question for the last minute. Now in that case, if you do have a very shorter period of time, you are trying your level best to complete the question in a hurry. But in this situation, there will be more mistakes, right? Now easily you can get this 28 marks, right? On the other hand, I am very not strict marker. I'm always try to give more marks for the students. Therefore, make sure that you are getting that marks without failing, right? Right. Then earning per share, how do you calculate? Net profit after tax divided by number of shares. Net profit after tax divided by number of shares. To take the net profit after tax, for this ratio also, net profit after tax means in the income statement, not the last item in the income statement, right? Last item is the retained profit, right? According to this question, last item is the retained profit. You have to take the net profit after tax. For 2014, 15 and 16, 29 million, 55 million and 56 million. Then take the number of ordinary shares. It is given under additional notes. There are 6 million ordinary shares outstanding, or they have issued 6 million ordinary shares for their shareholders. Now, here also, most of the people tend to make a mistakes, right? Listen to me very carefully. Now, if I go through a particular particular batch papers around 250, 30 papers are there, no? Out of those 300 papers, at least 10 to 15 people do this mistake. What is the mistake? Now, if you go to the question, 29,000 is given in thousands, meaning 29 million, right? And the income statement, 29,000, the income statement given in the top of the income statement, it's very clearly mentioned, figures are given in thousand, meaning your net profit is in actual terms 29 million. But if you go to the additional notes, the number of shares is given in normal terms, that is not in thousands, that is 6 million. They have written the 6 million as 6 and 6 zeros, right? What is the mistake the student do is when they calculate the EPS and the DPS, right? Earning per share and dividend per share, they take 29,000 as 1,000, right? As 1,000, they take the 29,000. But for number of ordinary shares, they directly take the 6 million figures, that is 6 and 6 zeros, not 6 million in thousands. To take the 6 million in thousand, it will be 6,000, right? 29,000 කියලා මෙතන ලියනවා. ඊළඟට අර 6,000 ගන්නේ නැතුව කෙලින්ම 6.6කුයි ලියනවා. Then what will happen to the ratio? Instead of this correct answer, 4.83 rupees, if you do have instead of 6,000, if you have another 3 zeros, that is 6 million in normal terms, not in thousand terms, the answer will be the answer will be 0.0483, right? 4.83 වෙනුවට එන්නේ 0.0483. Then it will be totally wrong, right? Make sure at least your batch, right? Don't do this mistake, right? I think my point is very well understood by you. Don't do that mistakes. These are very easy to calculate ratio. You have to take the net profit after tax of each year, divided it by number of ordinary shares outstanding. That is, in thousand terms, 6,000. If you want to calculate in real term, take the 29 million in also in real term. That is 29 6 zeros. Then the number of ordinary shares also 6 zeros, right? And then the EPS will be rupees 4.83. That is per share. This company earned 4.83 rupees in 2015, 9.17 rupees For 2016, 9.33 rupees. Right. Similarly, with the dividend per share, in the income statement, take the total dividend. Take the total dividend. It's very clearly given in the income statement. They say dividend for 2014, 18 million, 15, 27 million, 16, 36 million. Right? 36 million. Divided it by number of 14 shares. Again, 6,000 in 1,000 terms. 6,000 in 1,000 terms. Then dividend per share, the dividend they have declared in 2014, 3 rupees. In 2015, 4.5 rupees. For 2016, 6 rupees. 2014 to 2016, they have doubled the dividend per share. Now, from the perspective of a shareholder, it will be very attractive, but from the perspective of a management, it is not that much good, because that you have taken off bulk of. Now, if you are taking, if you are declaring dividend, means you are taking off your cash to the shareholders, if it is a cash dividend, right? Most of the shareholders would like to have a cash dividend. If it is a cash dividend, meaning you have taken off from 2014, you have taken off 18 million. In 2016, you have doubled that amount. 36 million have been taken off, right? If you can declare, if you could have declared the same dividend, that is 3 rupees for 2016 as well, and 2015 as well. 2015 also, they have increased the dividend per share by 1 rupee and 50 cents. Now, going through this slide, you can directly say, if they could have declared the dividend per share similar to the 2014 figure, that is 3 rupee per share, they could have saved, right? 2015, instead of 27 million, if they declared 18 million, they could have saved their 9 million. For 2016, instead of 36 million, if they declared 18 million only, they could have saved again 18 million. And altogether, 9 million in 15, 18 million in 2016, altogether 27 million they could have saved if they decided to have the same dividend for 2015, 16, same dividend that they have declared in 2014, right? They could have saved 27 million, right? Using that 27 million, they could have easily done their these requirements, right? That's how, even though now for a layman, this ratio is dividend per share is very attractive, 3 rupees, 4.56 rupees. But from the banker's point of view, even though it is increase in trend, but from your point of view, it is not that much advisable to provide higher dividend. Now, within 2 years period, they have doubled their dividend per share, right? That is not that much advisable. Even the ratio is very attractive from the perspective of shareholders, very attractive. Company is doing well. They, to be fair by the shareholders, they have done well, right? But from the company itself, they could have saved 27 million by declaring the same dividend in 2014 equal to 2014 dividend in 15 and 16. If they would have declared the same dividend, they would have saved 27 million, right? That's how you could interpret. But when it's come to interpretation part, we will take into account all of these things. Then we have calculated the EPS and DPS. Then earnings yield, they have given the market prices. Taking into account the market prices, EPS divided by the market price, then you have this earnings yield. very attractive, 26%, 47%, and 38%. Compared to the earnings per share, the market prices have the increasing rate of market price is higher. That's why there is a reduction in 2016 compared to 2015. And dividend yield, similarly, dividend per share divided by market value per share. There are also higher dividend yields. The main reason is your dividend per share have increased or double compared to the 2014 figures. 2016 figures have double. That's why you have a good attractive dividend yield. Starting from 16% to 2016, there is a 25%. Then we can summarize what we have calculated for interpretation part. Now, these are the profitability ratios that we have calculated. Under profitability, we have calculated, even though examiner asked about 4 ratios, we calculated 5 ratios. If the time permits, you can do any number of ratios in addition to the what is asked from by the examiner. But make sure that you are within the time frame in the exam, right? GP ratio very attractive. Net profit ratio, we have a question why it is so low. ROE and ROC is very attractive. Then interest cover also very acceptable, but a smaller decline in 2016. Now this is our interpretation. To take the interpretation, this is our the next ratios are current ratios, quick asset ratios, very acceptable within the limits. 1:2 and 1:1. Gearing ratio, we have concluded the company is in low geared position. No worries for gearing ratios. Then investor relation ratio, you have this EPS, DPS, earnings yield, and dividend yields. All ratios are very attractive. Right, we'll have our interpretation part. Coming back to profitability again, you can see my remarks. It may be seen that the GP, NP, net profit after tax, ROE, and interest cover ratios increase for financial year 2015, but decline in financial 2016. It may be attributable to the fact that the expenses increased by 1.135% compared to the increasing gross profit by 1.2% over the previous year. However, ROCE recorded an increase over the 3 years. But here, even though I have not mentioned, you have to clearly mention that we have a concerning net profit ratio, right? Net profit ratio for it to be very low, right? Even though you have a if you do a 100 rupees sales, you have a gross profit of 36 rupees. 36 rupees. From 36 rupees to come back to 6 rupees per share, right? For every sales, you have a net profit of every 100 rupees sale, you have a net profit of 6 rupees net profit. For that to be very low, you have to find out the reasons why it has come down drastically from 36 rupees to 6 rupees for every 100 rupees share. Therefore, make sure that you have a detailed analysis on the cost structure not the cost of sales, the other cost structures like admin cost, distribution cost, finance cost. Take into account all of these cost structures. What are the main items that have consumed bulk of the sales income, right? Bulk of the gross profit, right? For it to be very low as 6%, right? Therefore, there is a concern as far as net profit ratio is concerned. Then liquidity, you have to clearly mention the liquidity situation was almost near norms in the three financial period. That is liquidity to liquidity ratio, that is current ratio 1:2, and the quick asset ratio 1:1 is maintained by this company throughout the period, right? There is no issue as far as the liquidity is concerned. It is up to the standard. Then gearing, you have to clearly mention both the ratios, gearing 1 ratio and gearing 2 ratios. Gearing 1 ratio below 1, gearing 2 ratio below 0.5. Therefore, further facilities can be taken into account, since this particular company is more relied on the equity capital than the debt capital. This particular company, now if you go to the gearing ratio calculation, the summarized gearing ratios, if you take the last gearing ratio for 2016, 0.36 means out of the total capital, only debt capital is 0.36, meaning 0.64 are from the equity. 0.64 as a percentage, 64% are from the equity, only 36% are from the debt capital, right? That's why you have a low geared position. Therefore, that is very attractive for lending. Under investor relation, shareholder ratios such as earning per share, dividend per share are improving over the period, which is satisfactory. Although both earning yield and dividend yield improved in 2015, both declined in financial year 2016 due to increase in market price as at 30. But here also, even though I have not mentioned, you have to clearly mention dividend per share have double, right? Dividend per share have double. They have doubled the dividend per share from 3 rupee to 6 rupee, right? From the shareholder point of view, it is very attractive. If you have double the dividend per share, shareholders will be very happy. But from the perspective of the management, they could have saved at least 27 million, if they have maintained the same dividend per share, Normally, there is a norm of declaring dividend payout ratio of a similar uh, nature, right? If you declare 36%, 40% dividend payout ratio in 1 year, normally shareholders would like the same percentage to be maintained. Dividend payout means out of the profit, what you have distributed among the shareholders. That is dividend payout ratio. Then the balance part is the retention ratio. Out of the profit, what you have retained. If the dividend payout ratio is 40%, what you have retained is 60%, right? Therefore, every company would like to maintain the dividend payout ratio, right? Uh, not not by increasing the dividend per share, right? You are maintaining dividend payout ratio, but not increasing the dividend per share, right? For a company to double the dividend per share within a very short period of 2 years, then it will lead to take cash flows from out of the company, which might be used. These cash flows might be used in a future stage. Now, if you go to the question itself, they say they need some 10 million or some amount for their expansion, right? And they have a OD facility of 26 million. If they could have retained this 27 million, they easily repay this OD balance and save bulk of the interest for OD, right? That's how you should interpret. Under investor relation, you have to mention the dividend payout, dividend per share is double, but it is not that much recommend for them to declare a higher dividend, right? If they have struggling with the cash flows, they need to retain something. When the time is good, you can declare higher dividend, right? Then this is the risk analysis. This should be part of your answer sheet. This should be part of your answer sheet. I'll allocate at least 3 to 4 marks for this section. Risk analysis and conclusion, right? At least 3 marks. Under profitability, you can say profitability is good, but not risk, under risk, not low. Since the net profit after tax is there is a problem, the very low net profit after tax is there. Therefore, you cannot say the risk under risk measurement risk is low, right? We stated, that's why we stated medium risk is there. Under liquidity, risk is very low, right? Because the company has maintained the liquidity requirements in standard near terms, right? Gearing also very low risk. Shareholder benefits satisfactory. Therefore, further facilities can be considered. You have to conclude. Taking into account all of these things, therefore, further facilities can be considered favorably. However, we must obtain the audited financial statement for year 2016. For year 2016, they have not given the audited financial statement yet, right? Therefore, there is a requirement in getting the audited financial statement, because these 2016 figures have not been audited yet before releasing funds of approved facilities. Therefore, taking into account the ratios and the interpretation and the risk analysis, you can consider further facilities. Right, we'll see what kind of facilities this company can be offered. I have a few options for this company. If you take the requirement and the current positions, now if you go to this table, currently the existing limit is 80 million, outstanding is 62 million. Therefore, we have a leeway of the total approved limit is 100 million. Out of the 100 million, 80 million is the term loan, 20 million is the overdraft, right? 80 million is the term loan, 20 million is the overdraft. Now, out of that 80 million approved limit, they have repaid 18 million, right? That's why their outstanding balance is 62 million. 62 million is the outstanding balance, because their repayment is 18 million from the inception of this loan, right? But in case of overdraft, they have exceeded by 6 million, right? Now, we are going to propose within the current limit. Within the current limit, we are going to propose a new loan facility of 80 million. New loan facility of 80 million, right? Under proposed column, I am proposing a new loan facility of 80 million, right? And an overdraft facility of 20 million, right? That is within the 100 million limit, within the 100 million limit. What we are going to do is, using this new 80 million facility, right, with the funds, we repay the existing 62 million loan. We repay the existing 62 million loan. Then we are left with 18 million. 18 million. We are left with 18 million. Using that 18 million, we can repay the current overdraft limit of outstanding of 26 million, some part, and back to the limit mark, that is proposed limit mark is 20 million, right? Now, out of the 80 million, we initially repay the 62 million loan. Then we are left with 18 million. Out of that 18 million, reduce the OD balance by 8 million and balance 10 million for the new requirement, right? If you reduce the OD balance by 8 million, your current the new outstanding will be 18 million, which is within the 20 million limit, right? Which is within the 20 million limit, and you are left with 10 million, that is for the new requirement. That is one option. Currently you have, right, within the 100 million limit, you settle off the everything. Then the now what I'm going to already explain is listed here. Consider the existing approved limit of the term loan 80 million. Since the balance in the loan is less than the approved limit by 18 million, consider a new loan of rupees 18 million repayable in 3 or 4 years. Recover the existing outstanding of 62 million. Allow the company to utilize 10 million to purchase the computers and reduce the OD balance by 8 million and bring below the limit. Right. Then the second option, this is the second option. That is also within the approved limit of 100 million. We will reduce the proposed limit of the existing loan of 80 million from 80 million to the current outstanding amount 62 million, right? Reschedule the loan, just the limit, right? We are reducing the loan limit to the sanction limit to 62 million, right? Then it is within the outstanding amount. Then we have increased the overdraft limit from 20 million to 38 million. 20 million to 38 million. By doing so, the breach of this overdraft limit, now that also will get settled, and you are also left with additional 12 million, right? Increase the OD limit by 18 million so that it will be within the limit. Lease computers are required. Use balance 12 million excess to meet the lease rental and working capital requirement. That is the second option. Since two of the contracts signed are from, this is another option. In addition to the facilities by the bank, this is another option, right? That is kind of a third option. Since two of the contracts signed are from the overseas client, now it is clearly mentioned, two of the overseas clients, they have signed contracts with this company for the for some orders. We could request the supplier to open letters of credit through your bank and consider granting facilities against them, right? In addition to that, if we can ask, if we are in a good position, if we can ask for them to send some advances, right? If they can send some advances, then that will also resolve our problem. Then final one, the directors may consider to expand the business considering the overseas opportunity. Consider a company going for a 1 million new share issue. Now company is registered with they have a market price, right? If they can issue new shares of 1 million, say price is 220 rupees approximately, 20 million can be raised, right? Using that 20 million, they can reduce the overdraft balance and also meet up with the working capital requirement of 10 million. Those are the last two options are not within the bank, that's within the company's perspective, right? Those are the four options you can recommend. Right. We'll have a 5 to 6 minute break and we'll do the next question as well. That is 2016 November. That is also uploaded in the site. Right. We'll break for 5 to 6 minutes. Right. We'll start the second question. That is 2016 November 1. More or less you will be getting a similar question like this if you go through the past papers. The structure will be the same, but uh, this time the allocated marks will be not 28, it will be 30 marks, leaving me to have one or two additional essay type questions for like 2 to 5 marks. But anyway, the structure will be the same. Right. If you go to the 2016 November question, I'll read out the question. It's in the screen also. You are the credit officer of Royal Bank PLC. MS Fashions Apparel Private Limited is one of the leading exporters of ready-made garments with a brand name Butterfly and a prime customer of your bank and maintain satisfactory conduct current account at your bank. At present, they also enjoys the following credit facilities, right? Similar to what we have discussed, they have also term loan overdraft. Approved limit is or the sanction limit is 80 million and 10 million. Outstanding amount as at 31/3/2016, 58 million and 16 million. The term loan and the overdraft facility are secured by the mortgage of 90 million on freehold property owned by the company. Housings of a office complex and factory valued at 150 million. Now, if you take this exposure, the current approved limit of 90 million against 150 million value property, meaning 90 divided by 150, that means 60%. Against the property, you have lent 60% of approved limit. That is a current situation, right? They have a property against which you have lent or you have approved a 60% approved limit, that is 90 million. Because of the high quality of products, MS Fashion Apparel Limited, there is an increased demand for their brand name product Butterfly. In order to meet this requirement, the company has to purchase additional machinery at an estimated cost of 10 million and needs additional working capital of 5 million. Then altogether 15 million requirement is there. The CFO of Fashion Apparel Private Limited had approached your bank for additional facilities to meet their requirement. You as credit officer had requested for income statement of financial position of the company for the years 2014, 2015 and 2016. The summarized audited results for 2014, 15 and 16 are given below. The similar format is there. You have the turnover starting from turnover, cost of sales, GP for respective years, and expenses excluding interest, then explain profit before interest, then deduct the interest, then profit on ordinary activities, deduct the taxation, then you have net profit after tax, right? That is the profit for the year. Then they deduct the dividend and retain profit for the year. Then if you go to the balance sheet or the statement of financial position, you have three under assets, you have two non-current assets, land and building, machinery. Then current assets, inventory, receivable, and cash and bank balances. Then you have total assets. Under equity and liabilities, first item is the capital and reserves. Stated capital, 8 million ordinary shares are there. Then retained profit. Under non-current liability, your term loan is there. Your term loan is there. Under current liabilities, two items are there. Trade payables, meaning creditors. Then the bank overdraft, that 16 million is there in 2016. Screen. Okay. I think there is a problem. The presentation is not visible for you. I'll ask one of technical guys to support me. Wait for 1 minute. I think now it's visible. In the balance sheet also, I explained you under current liabilities. But if you go to the additional information, this question is somewhat different to what we have discussed at the as the first question. Under additional information, the following balances were extracted from the financial position statement as at 31/3/2013, right? 31/3/2013. Now the balances of 2013 is given for you to calculate the average figures for 2014, right? All balances are in thousands. Inventory, trade receivable, meaning debtors, trade payable, retained earning, there is a loss, right? Under retained earning, there is no profit, there is a loss, right? Total asset figure is the given. Term loan. Note, you may assume that the overdraft interest included in the interest expense amount reflected in the income statement is insignificant. You can assume that. You may use the average balances for computation of ratios wherever necessary. Now it is clearly mentioned, you have to use the average balances wherever necessary. Then 90% of the sales are on credit basis and 10% of sales are on cash basis, right? Company's stated capital is 120 million from the inception, consisting of 8 million ordinary shares. This question is totally different from what we have discussed, right? A lot of details are given and you have to carefully take into account all the details whenever necessary. The company stated capital 112 million, we mentioned that. A recent valuation of the property indicated a value of 170 million. Now that is for the property that they have mortgage. Initial value is it's 150 million. Now they have taken a new valuation report, right? The amount is 170 million. If the need arise, you can take into account that new valuation amount also, right? The requirement is you have to assess the risk position of MS Fashions Apparel Limited for granting additional facilities using the financial analysis focusing on important accounting ratios. At least 15 ratios you have to calculate, indicating the risk level. Ratio analysis 15 marks, risk analysis 5 marks, right? Altogether 20 marks are given. In the event of considering new facilities, describe the type of facilities you may recommend, 4 marks, right? Suggest your recommendation to the management of MS Passions Apparel Private Limited to enhance the financial position without requesting additional facilities from the bank. Normally bankers won't do this. This is kind of a consultancy services under part C. Now in the question itself ask don't ask facilities from our bank. You can do these things and fulfill your requirement, right? Part C like that. We'll discuss the part C in a later stage. We'll first calculate the ratios, right? Now make sure whenever necessary you take the average figures for balance sheet items if the necessity arise, right? Starting from the profitability ratio, gross profit ratio, very easy to calculate. I won't take that much of time, right? Take the gross profit, take the sales, then your gross profit ratio is 46% for 2014, 15 42%, 16 40%, right? Right. I think now all the people can see the presentation. Right. If you take the results of gross profit, 46 to 40% is there, more or less similar. Very attractive gross profit ratio. That means every 100 rupee sales you make, 46 rupee or 40 rupee, 41 rupee GP is there. But there is a decline. You have to worry about that, but more or less in a similar situation compared to the 3 years. Then net profit ratio also, if you go to the income statement, net profit after tax is given 39.4 million, 44.8 million, 51.2 million. Then sales, same sales figures are there, 350 million, 420 million, 510 million. Then taking into account the net profit after tax and the sales, the answers will be 11.26, 10.67, 10%. There are also a decline in trend is appeared, but more or less similar to 10 to 11%, right? 10 to 11% is there. Compared to the 40% GB, 10% NP is somewhat less, but acceptable to the bank. I think need not to spend much more time on calculating the GP and NP. It's very straightforward. You can easily calculate. Anyway, these answers are uploaded in the system. You have the answers with you. Then better you calculate yourself without waiting the first calculation done in the examination, right? Normally people do the first calculation as far as the ratios, this particular question is concerned. They do their first calculation in the exam, right? When you do the calculation, first calculation in the exam, if there is a mistake, you will get fail, right? But if you do the first calculation at home, if you have done a mistake, if you come across that mistake, then you can rectify that mistake in the exam. Therefore, make sure before going to the exam, you do the calculation part also, right? Otherwise, the final ending is not that much good for you, right? Therefore, net profit ratio and GP ratio acceptable. There is a decline in 2016, but that is a very small decline, but we'll give some remarks on that. Then return on equity, right? Now, if you come to this ratio uses two figures, one from the balance sheet, one from the income statement. Therefore, figures from the balance sheet need to be average figures. For you to calculate average figures for 2014, 13 figures also given in an additional note. Right. Now we'll calculate the return on equity. First, we have to take the net profit after tax. It's very straightforward. First line item, net profit after tax, 39.4 million, 40.4 million, 51.2 million. Very straightforward. Net profit after tax. Right. Then for you to calculate the average equity of 14, 15 and 16, there should be two figures. For you to calculate 14 average equity, you should have equity amount of end of 2014 and equity amount end of 2013. If you go to the balance sheet, ending equity is given. Ending equity, you can go to the equity and liability. Under equity and liability, the first item is capital and reserves. Under capital and reserves, stated capital 112 and retained earning 3.4 million. Then altogether 115.4 million. That is 115,400 is the ending equity. Then the beginning equity, how do you calculate this 92,000 beginning equity? In additional notes, under additional notes, it's clearly mentioned from the inception of this company, they have a stated capital of 112,000. Stated capital of 112,000. If you go to the what is that note? Note number 4. Under note number 4, the company stated capital 112 million from the inception. That means 112 million remain same. And you have to find out the reserve positions at the end of 2030. Now, on note number 1, retained earnings end of 2013 is 20,000 loss. 20,000 loss. 20,000 loss. Now you have to deduct from 112, deduct the 20,000 loss. From 112 stated capital, deduct the 20,000 retained earning. Why we deduct? Since it is a loss. 112 deduct 20,000, then it will be 92,000. It will be 92,000. It will be 92,000. That is the beginning equity of 214. Beginning equity of 214. Then ending equity is 115,400. Beginning equity is 92,000. Take the total, divide it by 2. Then you can arrive at an answer of 103,700. 103,700. Similarly, for 2015, the beginning equity will be for 2015, beginning equity will be the ending equity of 2014. The beginning equity of 2015 is equal to ending equity of 2014. That is 115,400. Then go to the balance sheet. Ending equity of 2015 will be, go to the balance sheet. In the balance sheet, 112 million stated capital, 16.2 million retained profit. Then total is 128,200. 128,200. Then add the total, divided it by 2, take the average. Then it will be 121,800. 121,800. Similar process for 2016. The ending equity of 2015 will be the beginning equity of 2016. That is 128,200 equal to the beginning equity of 2016. Then the ending equity of 2016, go to the balance sheet. Take the stated capital 112 million. Take the retained earning, that is 27.4. Then the total is 139.4 million. Take the total 128.2, 139.4, divided it by 2. Then you can calculate the average equities. The results of average equities are 103.7 million, 121.8 million, 133.8 million for 14, 15 and 16 years. You have the net profit. You have the average equity now. Net profit divided by average equity into 100, you have a return on equity. For 2014, 38%, almost 38%. 2015 also 37%. 2016, 38%. I think you will find it more difficult in calculating the 2014 average figures, but it's not that difficult. The beginning equity of 2014 will be the ending equity of 2013. 2013 ending figures they have given. Even if you take this stated capital from the inception, 112 million is there. Then you have to take add or deduct the retained profit for 2013 end. It's given in under note number 1, 20,000 loss. Therefore, what we have done is from 112 million, we deduct the 20 million loss. Then you can have the beginning equity of, or the ending equity of 2013, or the beginning equity of 2014, 92 million. If time permits, I will ask for you to unmute your mics and ask question, right? At the end of the lecture. If you want, if you have any questions, I will ask for you to unmute your mic, and don't unmute now, right? Right, we'll go to the next ratio under profitability. Now we have calculated the gross profit ratio, net profit ratio, return on equity, return on capital employed. Right. Now ratio says net profit before tax and interest divided it by the average capital employed, that is equity capital and the long-term capital, into 100. Now first we'll have to calculate the net profit before tax and interest. You have a figure called net profit before tax, 56,400, 56,800, 60,200. To add back the interest, then you can calculate the net profit before tax and interest, that is 69,000, 73,000 and 81,000. Right. Now we have to calculate the average capital Average capital means average equity capital plus the average debt capital. Average equity capital in the last ratio, that is return on equity, we have already calculated. Therefore, no need to calculate again. Go to the previous ratio. Average equity capital 103.7 million, 121.8 million, 133.8 million. I am taking the same figures for this ratio. Average equity, no need to uh, calculate the average figures, right? Again, therefore, average equity, I have used the same amounts, right? But for average long-term debt, you have to calculate that. Average long-term debt, if you go to a balance sheet, 2014, the long-term debt is 80,000. Now we have calculated 65,000 here. How do you arrive at the 65,000? How do you arrive at the 65,000? 2014 and 80,000. 80,000 plus. Then you have to know what is the figure, the long-term debts for 2013 year end. Now it's given in note number 1, long-term loan 50,000. Therefore, you have to add 80,000 plus 50,000. 80,000 means the year-end figure for 2014. 13 year-end figure is 50,000. Right? 80,000 plus 50,000 divided it by 2. Then you have a 65,000 average long-term debt for 2014. Similarly, for 2015, long-term debt is 68,000. Then 2013, 14 one is 80,000. Therefore, 80,000 plus 68,000, 148,000 divided it by 2. It will be 74,000. 74,000. Same calculation can be adapted for 2016. 2016 long-term debt is 58,000. At 2015 long-term debt is 68,000. 58,000 and 68,000. Add, divided it by 2, 63,000. 63,000. You have average equity now. You have average long-term debt for each respective years, 15, 14, and 16. Then take the total. Take the total of average equity and average long-term debts. Then you have average capital employed. For 14, it's 168,700. 15, 195,800. 16, 196,800. 196,800. Then you can calculate the ratio. Net profit before tax and interest. Net profit before tax and interest divided it by average capital employed. Average capital employed. Average capital employed. Into 100. Then your return on capital employed ratio will be 40.9%, 37.28, 41%, 16. All of these ratios are very attractive, right? For every 100 rupee capital, the company has generated 41 rupee profit. 41 rupee profit for 2016. Here the difference is we have taken the average figures, right? And the all the necessary figures are also given by the examiner for you to calculate average figures for 2014, 15, and 16. Right. Then return on assets. Return on assets. Here also you have to take the average figures from the balance sheet items. Return on assets mean net profit after tax divided by average assets. Average assets, because average assets are from the balance sheet, net profit after tax is from the income statement. That's why we have taken the average figures for the balance sheet one. Net profit after tax, straight away you can take from the income statement: 39,400, 44,800, 51,200. Then total assets beginning of the year, total assets ending of the year. For 2014, the beginning of the figure 180,700, you have to go to the note number 1. Under note number 1, they have mentioned total assets for 2013 year end. That is 31/3/2013. They say total asset figure is 180,700. 180,700. Therefore, 2014 year in total asset figure is, you can go to the balance sheet and take that total asset figure, that is 228,500. 228,500. Take the total, divided it by 2, then you have average total assets for 2014, 204,600. 204,600. Similarly, the ending 2014 figures of total asset will be the beginning figures for 2015. Then go to the balance sheet, take the 2015 end position, 2015 end position, and calculate the average. Calculate the average. Similar computation can be done for 2016 as well. I do not want to explain again and again. Very straightforward. Then you can calculate average total asset figures for 2014, 15 and 16. 2014, 15 and 16. Then take the net profit after tax, divided it by the average total asset figure of individual or respective years, and into 100. Then you can calculate the final answers will be return on asset. For 2014, it will be 19%, 15 also 19%, 16 almost 21%. Figures are very attractive. I think I already mentioned in a previous session, if you go to banks return on assets, this ratio will be around 1% to 2%. But even very worse in case of this year, it will be less than 1%, right? Normally, if you take banks profit figures, if you take a larger bank like a government bank, their profit might be 20 billion. 20 billion. Their profit might be 20 billion, but their asset size is 1 trillion, resulting ROA of 2%. ROA of 2%. 20 billion divided by 1,000 billion. 1 trillion means 1,000 billion, no? Their ROA is 2%. But in case of 2020, your ROA will be less than even 1%. Less than even 1%. Why? Your profits have been got affected due to this COVID-19 pandemic, right? There were some moratorium at a concession rates. There were loss of income from fee-based income, and loss of opportunities for further lending. And most of the banks have excess liquidity. They don't have lending opportunity. People have not asked for loans and advances. Even they ask for loans and advances. Banks are also like very stringent on their approving process, right? Interest rates have come down, right? Due to all of these ratios. Now, if you go to last year AWPLR and compare this year AWPLR, there'll be about 2 to 3% drop, right? Taking into account all of these factors, at the we can say the profit figures will be 50% drop, right? Now 6 month profit figures have been published, but in that 6 months also you cannot see that much of deviation. There'll be like 10 to 20% dropped in 6 month profit, but the real hit will come on third quarter and fourth quarter, right? The real hit will materialize in third quarter and fourth quarter. I think the as per the predictions, at least 50% drop can be seen if something now there is a government stability and a lot of positive are there, but even though those positive are there, the world also is facing the same problem still, right? Most of the people have lost their job. There'll be a lot of non-performing loans. Taking into account all of these factors, the profit figures will get be affected at least by 30 to 50%, result in further decrease in the return on assets. Now, my point is, since banks has a higher amount of assets, not like other companies, their return on assets is very low, right, compared to profit. Now, even though the inland revenue department, government, everybody says the bank is the banks are the people who generate higher number of profit. The value is the profit value figure is very high. 20 billion is a very big figure, but compared to their total assets, 20 billion is 2%. 20 billion is 2%, right? Therefore, our ROA is, banks ROA is will be like 1% to 2% in normal scenario, but in case of 2020, it will be less than 1%, even less than 1%, right? Then if you take this company, that is 19%, 20%, because in these companies now, if you take this normal business organization, they do not have this luxury of asking deposit from the normal public people, right? General public, we can ask as bankers, we can ask general public to have their deposit in our vault. But in case of normal business company, they don't have that luxury. The total asset should be either financed by way of loans, or either the company equity holders will have to fund the same, right? Therefore, that's why their capital, their total asset figure is very low compared to the profit. But in our case, our total assets are very high compared to the profit. Then interest cover, no need to take averages since we are dealt with the two figures are from the balance income statement. Net profit before tax and interest divided by interest. Previous question also we have calculated this ratio. This is expressed as a number of times. Net profit before tax, add the interest, net profit before tax and interest. You have 69,000, 73,000, 81,000. Divided again it by interest, 12,600, 16,200 and 20,800. Then you can calculate the interest cover ratio in times. 2014 it will be 5.48, 2015 4.51, 2016 3.89. The ratio is declining. That is not a good sign, right? From 5.48 times, meaning in 2014, using your profit, you could have paid your interest 5.48 times. But in case of 2016, that ratio, that number of times have come down to from 5.48 to 3.89. That is not a good sign, right? Higher the number of times, better it is as far as interest cover ratio is concerned, right? We will have to give some remarks on this interest cover ratio when the interpretation part is materializing. Then liquidity. Under liquidity, you have very straightforward calculations. No need to take averages since both figures are from the balance sheet. Current assets and current liabilities, both figures are from the balance sheet. No need to take averages. Under 2014, current assets and current liabilities are given. To divide the current assets by current liability, then it will be 1.56, right? That is one current liability to 1.56 current assets. Every year, if you take 2014, 15, and 16, the same ratio you can see, that is for one current liability, there is only 1.5 current assets. Normal standard is two current assets for one current liability, but this is not that much bad, but we have to take into account the industry in which they are operating, whether this ratio is acceptable or not. I will go to the second ratio under liquidity, that is quick asset ratio. You have to take off the from the current asset, you have to take the inventories out, then you can calculate the quick assets. Normal ratio is 1:1. If you calculate the quick asset ratio for this company, you can see it's there 1:1, almost 1:1 for 2015 and 16 as well. Therefore, even though current ratio is 1:1.5, but quick asset ratio, they have maintained 1:1 position. And there is no much variation from 2014 to 2016. That is also an acceptable reason for the liquidity. We can say liquidity risk is low. Then we'll discuss some ratios of efficiency, that is inventory turnover and inventory turnover period. For easy explanation, I will go to the inventory turnover period. Right, inventory turnover period. I skip this inventory turnover ratio. Right, for your understanding and computation, make sure that you calculate and get better understanding on the second ratio, that is inventory turnover period. Both ratios are equal importance and equally acceptable, but for better understanding and explanation, the second ratio is recommended. How do you calculate the inventory turnover period? You have to take the average inventory divided by cost of sales into 365. Since cost of sales is from the income statement, inventory is from the balance sheet, we have to take the balance sheet figure in terms of averages. Right? First, you go to the income statement, take the cost of sales. Cost of sales 189,000, 240,000, 302,000. Or in millions term, 180 million, 240 million, and 302 million. Right. Then for you to calculate average inventories for 14, 15, and 16. For 14, you need to know the beginning inventory. Go to node number 1. Under node number 1, they say the beginning ending inventory as at 31/3/2013. That is year end 2013 is 15,500. You can take that as the beginning inventory of 2014, 15,500. Ending inventory, go to the balance sheet. Under balance sheet, it's there under current assets under 2014, 18,500. Then take the total, divided it by 2. Similarly, you can calculate for 2015, 16 as well. Take the average inventory. Then how do you calculate average inventory divided by cost of sales into 365? Average inventory divided by cost of sales into 365. Then answers will be 33 days, 32 days, 34 days. Meaning your inventories are laying in stores 33 days or 34 days, not being converted into sales. Right? In other words, it will take at least 1 month an inventory item to be converted into sales, right? If you purchase one item today, it will be there for 30 days, not being converted into sales. That is the interpretation of this inventory turnover period. Similarly, next ratio, debtors collection period. How do you calculate the debtors collection period? Take the average debtor divided by credit sales into 365. Here the credit sales or the sales are from the income statement. Debtors are from the balance sheet. Therefore, we have to take the debtors figures as average since it's a balance sheet figure, right? Now, how do you calculate the credit sales? Under note number 3, under note number 3, they say 90% of the sales are on credit basis and 10% of the sales are on cash basis. 90% of the sales are on credit basis, 10% are on cash basis. Go to the income statement, take the 90% of the sales. That is for 2014, 350,000 is there. Take the 90%. That is 350. 2015, 420,000 is there as sales. Take the 90%. Then it will be 378,000. Go to 2016, 510,000 is there as sales. Take the 90%. Then it will be 459,000. This is like spoon feeding, but I know for sure that this will be helpful for you to get a better understanding. Then you take the credit sales, then you need to calculate the average debtors, right? For you to calculate the average debtors, you have to have the debtors beginning of the year and debtors ending of the year. For 2014, the beginning debtors mean 2013 ending debtors. Go to note number 1, trade receivable. There is a balance of 25 million or 25,000, right? That is the 2014 beginning debtors. Then go to the balance sheet, and the balance sheet and the current assets receivable are there 27,000. That is the end figure for 2017, that's 2014. Then take the total, divided it by 2, you can have the average debtor balance. Similarly, you can calculate for 2015 and 16 as well. Similarly, you can calculate 2015 and 16 as well. And you can calculate the debtors collection period. Average debtors divided it by credit sales into 365. Then your debtors collection period will be 30 days, 30 days, and 31 days. 30 days, 30 days, and 31 days. Now, how do you interpret this? This means your debtors will take 30 days or 1 month period to pay your debts. If you do a credit sales today, it will take another 30 days that particular debtor to repay. Meaning your money will get stuck with the debtor. You have to finance that debtor for 1 month period. Now there'll be some problems if you are not given how to calculate the credit sales figure. In that case, if you are not in a position to calculate the credit sales, you calculate using the sales figure, assuming that 100% of the sales are on credit basis. 100% of the sales are on credit basis. Right. We'll go to the next ratio, that is creditors payment period. That is how long you will take to pay your creditors. How long the company will take to pay the creditors. How do you calculate? Average creditors divided by purchases or the credit purchases into 365. Right. Now, in this formula, average creditors you can calculate, but purchases figure is not given. Purchases figure is not given, right? You cannot see any figure for purchases. How do you calculate the purchases figure? Now, normally, I'll use the whiteboard. Hope it is clear for you. If you take the trading account, opening stock plus purchases, say some figures 100, 90, then 100, sorry, 10, 90, 100, deduct the closing stock, say 20, you have a cost of sales of 8, right? If the purchases figure is not given, if this 90 is not given, if you know this 80, if you know this closing stock, if you know the opening stock, you can calculate. How do you calculate? For this 80, add this, you deducted in arriving at cost of sale, but you are now reversing. You have to add back this 80 to this 80, this 20. You add back 20, then you have 100. Back calculation. When you add in this calculation, you have to deduct. Deduct from 100, deduct 10. 10, 9. This is a deduction, this is a add back. From cost of sales, now if you do have opening stock, sorry, you do have opening stock, you add purchases, you deduct the cost of sales to be arrived at, sorry, closing stock to be arrived at cost of sales, right? In order to calculate the purchases, I leave aside purchases this side equals cost of sales. You opening stock here positive. When you take the one item to the next side of the formula, it will be deducted, minus sign. Cost of sale, deduct the opening stock. Here the minus sign. When you go to the next side of the formula, it will be plus sign. Closing stock will be added back. Right? using this technology, using the technicality, we can calculate the purchases figure even though it is not given in the question. Right. Now you are being given the cost of sales and you have the inventories beginning and inventories ending, then you can calculate the purchases figure. Now here now since some people are not clearly seeing the whiteboard, now you can, if you go to this slide, you can clearly see how I have arrived at the purchases figure. For 2014, I'll take the 2014 figures and explain it. Cost of sales figure is 189,000. Cost of sales figure is 189,000. You have to add back the beginning inventory. Sorry, you have to deduct the beginning inventory, add back the ending inventory, right? Then you can have the purchases figure from 189,000, that is cost of sales. You deduct the beginning inventory, add back the ending inventory, right? Then you can arrive at a 192,000 purchases figure. 192,000 purchases figure. Now this beginning inventory figure, that is opening stock 2014, you have to go to the node number 1. 2013 inventory figure, you have to take that 15,500 as the beginning inventory figure for 2014. And ending inventory figure, go to the balance sheet under 2014 under current asset, the ending inventory figure is there. Here we deduct from the cost of sales the beginning inventory and add back the closing stock. Normally we, from the purchases, we add back the opening stock and deduct the closing stock to arrive at the cost of sales, but now we are reverting back, right? In that situation, you have to deduct the opening stock from the cost of sales, add back the this ending inventory, right? By applying the same formula for 15, 16 also, you can calculate the purchases figure. Here you have to have another assumption that since the examination is on silent on the credit purchases, you have to assume that 100% of the purchases are on credit basis, right? Creditors only. Now here you want only the credit purchases, because creditors only come into light when you do credit purchases. If it is on cash basis, no creditors, right? Therefore, you have to assume that 100% of the purchases are on credit basis. Similarly, for creditors also, you have to take the average credit balance, the beginning creditors and ending creditors. 2014, the beginning creditors will be you have to take from the node number 1. It's there, 22,700 amounts payable, or the trade payables 22,700 under node number 1. Take the total and divided it by 2. You can calculate the average figure. Normally in the physical classroom, I normally invite out of the 200 to 300 students, out of only few people will get the chance to come to front and do the calculation. But here I don't have that luxury of asking for you to do the calculations. but make sure that you get the points very correctly, right? At the latter part of the session, I will ask if people are interested in, you can ask any questions, even using your text messages, or if you want, you can unmute your mic and ask a question. Right, okay. Then divided the average creditor by purchases into 365. Then your creditor's payment period will be 44, 42, and 42. Meaning you are taking, as the company, you are taking 44 days to 42 days to pay your creditors. It will take about 44, 42 days to pay your creditors. Right. Then asset turnover. Here also we take the turnover and the average assets. Straight away I'll go to the calculation. Your turnover is sales. It's given in the income statement. Average assets, you have to calculate the average assets. Since one figure is from the balance sheet, you have to, and the other figure is from the income statement, you have to take the balance sheet figure as average. Total average assets. Then calculate this ratio interpreted in number of times. Turnover divided by number of times. 1.71 times, 1.79 times, 2 times. Meaning, using your turnover, you can purchase in 2014 1.7 times of your assets. Using your turnover in 2016, you can purchase 2 times of your total assets. Higher the number of times, better it is. Higher the number of times, better it is. This is kind of efficiency ratio. Using less total assets, what is the turnover you generate? That's why higher the number of times, better it is. If you can generate more sales using lower total assets, right? For this company, they generate using their total asset 2 times of sales to the value of total assets. Their average total asset figure for 2016 is 46,700. They generate double that amount of sales, right? Using their total asset figure. That is a kind of a efficiency ratio. Then this is also kind of efficiency ratio. Non-current assets to equity. This is also expressed in times. What is your non-current assets position compared to equity? If the ratio is higher, better it is. Compared to equity, if you do have higher number of higher value of non-current assets, that is assets that generate more income for a longer term period, the ratio is getting reduced. That is not good, but higher the ratio, higher the number of times, better it is. Since the both figures are from the balance sheet, no need to take average figures. Gearing ratio, right? Gearing ratio, I won't take that much time since we have calculated this ratio in the first question as well. Take the for the first ratio, you have to take the long-term debt and the total equity. Total equity, 2000, no need to take averages. Total equity straight away you can take from the balance sheet. Under long-term debt, you have to take the bank loan given in the long-term debt capital or the non-current liabilities. The ratio will be 2014, it will be 0.69, 0.53, 0.42, less than 1. Less than 1 meaning low geared. Less than 1 meaning low geared. Long-term debt divided by equity capital, right? Less than 1, low geared. Then for the second ratio, for you to calculate the total debts, you have to add back the short-term debt as well. for short-term debt, there are two kind of current liabilities. That is trade payables and bank overdraft. You won't take the trade payable. You only take the bank overdraft figures, right? At the 9,000, 12,600, 16,000, 14, 15, and 16. Then your total debt is 89,000, 80,600, 74,000. Add back the equity capital and calculate the total debt, total capital as well, because in the second ratio we are comparing the total debt versus total capital. Therefore, by adding the total for the total debt, add the total equity part, also calculate the total capital. Then it will be 204, 400, 208, 800, 213, 404, 14, 15, and 16. Then divide the total debt by total capital. Total debt by total capital. Then if it is less than 0.5, it will be low geared company. 14.4, 30, 15.39, 16.35, the ratio is getting reduced. All three cases less than 0.5, low geared company. Low geared company. Right. Some investor relation ratio. You have to make sure the point I made in the first question calculation. Here, number of ordinary shares is 8 million. You have to take 8,000, not the 8 and 6 zeros, right? Net profit after tax, take the net profit after tax, not the last item in the income statement. Take the net profit after tax, divided it by number of ordinary shares outstanding, that is 8 million for all 3 years. Therefore, your EPS will be 4.93, 5.6, 6.4. Your EPS will be 4.93, 5.6, 6.4. Very good, very impressive. We can see an increase in trend. Then dividend per share, total dividend 16,000, 32,000, 40,000, divided by number of ordinary shares, 8 million in each year. Dividend per share, very straightforward, 2 rupee per share, 4 rupee per share, 5 rupee per share. We can see the similar trend for 2 years. They have not only double, almost triple the dividend per share, right? From 2 rupees to 5 rupees per share, right? That is not that much recommend if you have a financial difficulty situation. If you do have cash balances like these years, if you have excess cash, you can pay dividends. But if you are struggling with cash, if you are planning to expand your business, a higher dividend per share is not recommended, right? The balance you have to take from a bank or financial institute to facilitate your whatever the requirement, right? Therefore, it is recommended to retain something for the expansion as well, or the future planning as well. Don't go and declare higher dividend to the satisfaction of shareholders. It is not recommended. From the perspective of shareholders, they would like, right? They would like to have higher dividend, but from the perspective of the company and the management, this is not that much recommended. Then the dividend cover, you have to take the total net profit after tax divided by dividend paid. This is number of times. You can say, since we have paid higher dividend compared to the increase in the net profit after tax, your dividend payment is higher, right? the dividend net profit after tax, it has not been increased that much, right, as a percentage, but your dividend paid amount not only double, almost triple the amount, 16,000 to 40,000, right? That's why your dividend cover ratio have declined from 2.46 to 1.26, right? Now we will do the interpretation part. Uh, uh, as a summary, profitability ratio, we have calculated GP, NP, ROE, ROCE, and interest cover. One by one, we will explain. And for working capital and efficiency ratios, we calculate the stock turnover period, debtors collection period, creditors payment period, then asset turnover period times ratio, and non-current assets to equity ratio. For liquidity, current and quick asset ratio. For gearing ratio 1 and 2. And there are some investor relation ratios also we have computed. Now, one by one, we will do the interpretation and the final risk analysis part also. Now, carefully listen to me. You have to state for individual ratio that you have computed in the exam a kind of an interpretation. Otherwise, the examiner won't get anything out of the ratio that you calculated. For interpretation also, some marks will be allocated, right? Don't just merely calculate and just present it. You have to follow the format that I'm presenting here in the exam as well, right? Under profitability, it may be seen that both GP, net profit after tax ratio, have decreased over the last 3 financial years. This may be attributable to the fact that the cost accelerating at a higher pace compared to the sales. There are some declines, but you have to seriously see whether compared to the income increases, what has happened to the cost, right? Management should take steps to control cost or increase in prices or restore higher GP ratio. Now, it's very difficult to increase the sales prices. If you compare it with your competitors, it will be very difficult for you to increase the sales prices. But in most of the cases, you have to see the cost reduction, right? It may be noted both ROE and ROCE, although decline in 15, improved in 2016 due to decline in borrowing. Right. Interest cover decline over the period, but above the accepted level. If you go to the interest cover, there was some decline, but you have to make sure that it is at the accepted level. Under liquidity, the liquidity situation was almost near terms in 3 financial period. 1 is to 1.5 for current ratio, and 1 is to 1 under quick asset ratio, more or less similar in all 3 years. Therefore, we can say liquidity situation is good. The gearing also, gearing ratio 1 is below 1 and gearing ratio 2 is below 0.5. Both ratios are declining over the financial years, indicating enhanced capacity for borrowing. For banks' perspective, this is the best ratio for you to consider for additional facilities, since the company is more relied on the equity capital than the debt capital. Then investor relation ratio, shareholder ratio such as dividend cover and earning per share are improving over the period, which is satisfactory, right? Is satisfactory. Then this is the risk analysis and conclusion. Profitability, medium risk is there. Even you can say low risk. Liquidity also same, medium risk is there. You can say low risk as well. Then the gearing, you can no issue saying low risk. Shareholder benefit satisfactory. Because of the medium profitability, liquidity risk, and declining interest cover, one has to exercise caution in considering further facilities. Because of high demand for the products of the company, one could expect profitability to increase. In such circumstances, fully secured further facilities could be considered favorably. Right. This kind of a conclusion you have to say at the end of the interpretation part. Now, that is for question number 1. Then we'll go to the question number 2, the additional facilities you would consider for this company. Right. There are few options. I'll take one by one. The first option, current existing limits is 80 million term loan, overdraft 10 million. The total facility amount is 90 million, right? Total package is 90 million. Outstanding 58 and 16 million. The first proposal, we will decrease the current term loan limit from 80 million to 59 million. 80 million to 59 million. And expand the overdraft limit from 10 million to 16 million in order to ensure that there is no limit breaches under overdraft. And we are now, by doing so, we are left with 15 million within the current exposure of 90 million. Within the current exposure of 90 million, new 59 million overdraft term loan by reducing the existing limits from 80 million to 59, and a new limit for overdraft from 10 million to 16 million, and a new loan of 15 million in order to compensate their current requirements of new machines and working capital. Right? That is a first option. There is a detailed explanation also. Option 1, consider the existing approved limit of the term loan 80 million. Since the balance in the loan is less than the approved limit by 18 million, reduce the limit to 59 million. Consider a new loan of 15 million repayable in 2 years for the current requirement. Increase the OD limit to 16 million and ensure that the company operates below the limit. That is option number 1. That is option number 1. Then this is the option number 2. That is also considered within the same limit. You will give a new loan of 80 million. New loan of 80 million. And using that 80 million, settle the term loan of 58 million and 16 million overdraft. By doing so, you want only 74 million, and you are left with 6 million. That 6 million can be used for working capital purpose. And for the balance 10 million, we are left with 10 million out of the 90 million. No? For that 10 million, give a lease facility for machinery. Lease facility for machinery. Right? I will have a detailed explanation also for that option. The company has an approved limit of 90 million. Consider new loan facility for 80 million amount repayable in 3 or 4 years. Recover the term loan and the overdraft fully. The balance could be utilized for the working capital requirement, that is 6 million. A lease facility to be used to purchase the machinery by mortgaging the asset. But in this option, you have to consider the interest rate applied for in overdraft and your loss of income. But this is another option if it is positive. Then number 3, option number 3. Now for this option number 3, I have used the new valuation report. I have used the new valuation report. Current valuation report is 150 million. New valuation report is 170 million. Out of that 170 million, you can have a 60% exposure. That means 112 million, 102 million, sorry, 102 million, right? You will give a new loan of 90 million. There can be various options if you take into account the new valuation report, but I am proposing one option only. Give a new loan of 90 million and recover the term loan and overdraft, that is 74 million. Then you are left with about 16 million, right? By using this new 90 million loan, you can recover the overdraft and the term loan, existing term loan, amounting to 74 million, right? By doing so, you are left with 16 million with the new loan. And with that new loan, 16 million, you can use that for machinery purchase and working capital, right? And since we are left with another 12 million, you can have a new OD facility for 2 million and a packing credit facility for 10 million if they want to be used, right? Since they are exporting their items to foreign countries, they can use this packing credit facility also. Option number 3, the new value of the property is 170 million. Mortgage value is at 60% will be 102 million. Approve a new term loan of 90 million, recover the existing loan outstanding 58 million and OD of 16 million. Out of the balance, allow the company to purchase machinery of 10 million and working capital of 5 million. The balance of the limit offered a packing credit facility of 10 million and an overdraft facility of 2 million to be used if needed. Or even you can, instead of this packing credit facility, you can approve 12 million overdraft, right? Right. That is for question number 2. Under question number 3, they ask, suggest your recommendation to management of MS Passion Apparel Limited to enhance financial position without requesting additional facilities from the bank. Now, in this question, you are not allowed to ask additional facilities from the bank. In that situation, what you are going to do as a bank, not as a bank manager, but as an advisor or the consultant to the company, what kind of proposal you can see, right? We'll have some proposals. Number 1, the company was paying higher dividend in the financial year 15-16, right? I have already mentioned that proposal in my previous explanation also. The company may pay similar to 2013 by which about 40 million can be saved, which could be used to reduce credit facilities. That is one option, but it has already forgone, right? Now you have declared no. Therefore, that even though we are mentioning that option, 40 million option, how do you get this 40 million? Dividend per share. Where is dividend per share? Dividend per share, 2 rupees, 4 rupees and 5 rupees. You have 8 million shares. If you have declared 2015 2 rupee dividend, 8 million shares means 16 million dividend. You can save at least 16 million, sorry, 8 million there, 8 million there, 15. And for 2016, additional 3 rupee, that means 24 million, right? 20 additional 3 rupees into 8, that is 24 million, right? 24 million and 16 million. 2015 you could have saved 16 million. 2016 you could have saved 24 million. The altogether 40 million is saving is there by declaring a similar dividend in the 2014, that is 2 rupee per share. Now, even though we are mentioning that option, that is already foregone. because now we have already declared that. Then the second option, the company could consider for a debenture issue, right? Since company is a very good company, having listed in the market, they have a market price for share. They could have issue rupees 50 million worth of debenture at a lower than the bank borrowing rate, right? That is also an option, but make sure that the debenture rate is lower than the bank borrowing rate. If you can borrow at 15%, say 15% from the bank, if the debenture rate is 16%, there is no mean of issuing debentures. And the other thing is, when you are issuing debenture, there will be some administrative issues also. Therefore, make sure that if you are issuing debentures, the rate that you offer to debenture holder is less than the bank borrowing rate. That is one point. Because of the company dividend policy and the demand for the brand name, one could expect full subscription, right? Definitely they can issue debenture, but make sure if the debenture rate is higher than the bank's borrowing rate, then there is no point of issuing debentures. Then the third option, option number 3, the company debtors collection period is almost a 1 month, right? Almost a 1 month. What is the debtor amount for 2016? Debtor balance is 42 million. Debtor balance is 42 million, right? If you can reduce by half the debtors collection period, meaning immediately you will get 21 million, right? Therefore, we recommend another option. We may have to offer discount for early payment, which may reduce the profit. A reduction in the collection period may not be viable. Oh, we can reduce, but the more important thing is if you can ask debtors to pay within 15 days, if that is not affecting your sales, right? Then you can collect part of the debtors, that is 42 million part of, you can collect and use that amount to this whatever the financial requirement you are having. That is another option. Then option number 4, the net asset value per share is 17.42. How do you calculate? You go to the total equity. Total equity is 139.4 million. 2016 139.4 million is the total equity. Divided it by 8 million ordinary shares. Then you are arriving at a figure called 17.42 rupees per share. That is called book value of a share. If the directors consider 16 rupee new share issue for 6 million shares, they could have realized 96 million. That is a new share issue. The proceeds of the issue may be used to meet the present requirement and settle all the facilities. This may be reduce the finance expenses, but the company must enhance profit at least by 12 million to meet additional dividend of 2 rupees per share on newly issued shares. Then there should be, if you are issuing new shares, the existing shareholders or the directors should be agree with this proposal, right? The existing directors should give their agreement for this proposal. It is very unlikely the existing people will give their agreement, because they have to fund this share issue. If it is go to the market, there won't be problem, but sometimes the existing directors won't like to go to market because then different newcomers will come to the company and they will take the control of the company. Therefore, for this proposal, even though we can issue new shares, but the existing directors should give their agreement. Finally, because of the high demand for the company's products, in case of confirmed orders, the company may request advance payment for orders. This may reduce the bank borrowing. Now they said that they have some confirmed orders. If they have a good bargaining power from their customers, they may request some advances from their customers. By doing so, they may have some money and use that money for the current requirement. Right. That is for the day. Then I'll ask if you are interested in, I'll give my mobile number. For if you need any clarification, you can call me. It's note 772 note 9 note 89 note. It's note 772 note 9 note 89 note. If you do have question, you can unmute your mic and ask any questions. If you want, you can send a message using this platform. I'll give 5 to 10 minutes. If there is no question, I can wind up the class. Thank you very much for listening to the 4 sessions. If you do have question, you can ask, unmute your mic and ask. I think after the 2 weeks, you will be your lessons, all the lessons will be get completed. You will have a question, 2 question paper this time. That is 1 question paper for this particular financial modeling, and another 20-mark question for 50 mark. That is 1 question paper, and for all the theoretical stuff, there will be separate question paper for 100 marks. By averaging all the marks taken for the 2 question papers, you will be given a final result. But make sure at least 50% of marks that you have taken for individual papers, right? If you do have question, you can ask, unmute your mic and ask. If you just the starting time of the next session will be the normal time, that is 8:30 to 8:30, I suppose. This is only applied for this financial modeling session only. Sorry, I couldn't mention that, right? Don't come at 7 a.m. Next week, right? If you do not have any questions, I will like to wind up the session. Then thank you very much. Make sure that you all pass the exam. Make sure that you have write something for me to get through your to all of you to the exam. I'm not a strict marker. Make sure that you have followed the steps that I have mentioned. Do the 2 questions that I have discussed, more or less similar to the same structure. Your question will be the same also. Thank you very much again. Examination date, I don't have the examination date. It will be informed to you, right? But anyway, it won't take that much long, right? Now now we can keep all the exams, since A levels and everything is going on. There'll be within a very limited period of time, you will be having the exams, right? Right. Anyway, right. Okay. Thank you very much. Happy to see you again. Right. Okay. Bye.